Okay, so I'm going to talk about a couple of papers today, and the first one is Carry in Time Series Momentum, a Match Made in Heaven. This paper actually just came out in the Journal of Alternative Investments in the fall of this year. And once again, I wrote this paper with Jun Kai and Xiaohua He. So let's talk a little bit about this whole topic and why I think it's interesting. So one, I'd like to clarify what time series momentum is. A lot of the times people say, oh, momentum. And there's a lot of confusion between time series momentum and cross-sectional momentum. Most academic literature is about cross-sectional momentum, which is all about persistence in relative performance. In other words, winners are going to win and losers are going to continue losing. And it's typically captured by long-short strategies that go long winners and short losers. And time series momentum is all about persistence in absolute performance. So if the markets are going up today, they'll continue going up tomorrow. If they go down today, they'll continue going down tomorrow. So time series momentum and cross-sectional momentum are similar, but they're also distinctly different from each other.
And time series momentum is often used in the same breath as trend following.
Exactly. So time series momentum and trend are the same thing. Mm-hmm. It just time series momentum is an academic term for trend. And then if you look at carry trade is a very popular strategy. It's really all valuation based. So if you look at some kind of ratio that makes sense, it could be like maybe P ratio in stocks. In case of futures markets, it can be basis between spot and futures contract. And what's also interesting about futures markets is that with futures markets, it doesn't really matter what the underlying is. You can actually define carry trade very simply by looking at this futures basis. It's kind of like a universal predictor across all asset classes. And actually, I wrote my dissertation on that. But anyway, so the question we asked was, when you look at carry, we know that carry or basis are predictive of future performance across multiple asset classes. There's lots of research on that. And the question is, if carry is positive, then the asset is more likely to continue going up. And then the question becomes, is it more likely that you're going to see more positive trends in that market? And if that's the case, it's quite likely that if you condition the trend signal on the sign of basis, you're more likely to build a system that's going to be consistent and profitable. So that's kind of the thesis that we had.
So maybe it may be worthwhile for you to spend a little bit of time describing why, like the theoretical basis for carry, right? So you've got a market where the term structure of futures is in backwardation or the term structure is contango. What dynamics are happening there that cause us to expect positive or negative returns on the front month, given the term structure there?
Well, that's a great question. So there's actually a lot of research on that's been published in commodity markets. For example, like there's a Fama French 1988 paper that talks about metals, and in their case, they were really trying to tie this relationship to the convenience yield. So in case of metals, for example, if you look at copper, for example, if everything is going well, if the business, you're in expansion, then you anticipate that copper is going to be high demand, right? And if the copper is high demand, there's actually very significant value of having physical copper because it's used for production. And therefore, because of this very high convenience yield, you're going to see basis going up. And that's why there's this, there's a business cycle effect when convenience yield is high, when basis is high, you expect that future returns are going to be positive. So that's kind of the discussion that
so when basis is high relative to the front month future.
Sure. Yep.
Right. Okay. Yeah.
Well, typically what happens is that whether you look at basis of front month versus underlying or further out versus front month and so on, those tend to be predictive future returns, maybe for slightly different horizons, but in general, high basis means higher return.
So we typically say that carry is the return you expect on holding an asset if the price doesn't change, right?
Exactly.
So in bonds, it's the coupon of the bond. In stocks, it's the dividend on the stocks. In commodities, it's the roll yield on the commodity as the front month moves, or as whatever the commodity, whatever contract you own becomes more mature, right? And so it rolls up or it rolls down the curve, and depending on what the slope of the curve, then the expected yield on that is positive or negative, right? And that occurs.
That's exactly right.
Right. Okay. Yeah.
So when you look at
basis,
basis, so what I like about basis in the futures markets is that you don't need to worry as much about what it's related to. Like, for example, as you mentioned earlier, in stocks, it would be dividend yields, right? But you can actually, that basis in the futures markets for equities is going to be roughly expected dividend yield minus the risk-free rate, okay? Or in case of fixed income, you talked about coupons, that's a very similar relationship. Or in case of foreign exchange markets, it would be interest rate differential.
Right.
So what's nice about using futures market for carry research, you can actually, instead of looking at multiple different ratios that are meaningful in different asset class, you can actually come up with unified return predictor you can use across all asset classes. And actually, my first dissertation paper was exactly on that. I was showing that futures basis is a universal predictor across all asset classes.
Nice. And it's great because it reflects the expectation and not the historical value of those variables.
Exactly.
It's forward looking. Good. So you've got this carry signal. You've got you're measuring. I think you measure basis as the difference between spot and the front month contract. Is that right, or are you measuring between front and back month? This paper
between front and back.
Front and back. Okay, gotcha.
Yep.
Yeah. And you create construct a thesis for why positive carry assets are more likely to result in persistence of positive trends and vice versa in general, right?
Exactly. That's exactly right. Yeah, so a couple of things to add to that. So you asked the question, how do you define basis, whether it's the difference between front month and spot, or further out contract and spot, or further out and front month. And when you look at the literature on commodities, it's really hard to talk about underlying or spot. That's why in commodity literature, typically the front month is considered to be the spot. And that's what's used for analysis a lot of the time. So we use the similar methodology for other asset classes as well, because it's unifying across all assets. It makes it easier for us to apply the same methodology for all asset classes.
Right. Nice. And so just how powerful is this relationship where, if you condition time series momentum on carry, first of all, what was your thesis for why this pairing should be effective? And then what did you find in practice? Well,
so let's just say that if in commodity markets, for example, basis tends to be negative. If basis is negative, you actually expect that returns are going to be pretty poor in commodity markets. And that's exactly what we've seen. I remember there were some articles or opinions in Wall Street Journal, Financial Times last year about how investors were thinking about walking away from long-only commodity investing because they did not believe in long-term positive returns in commodities. And the reason for that is really because of negative carry. So what happens is that if you see high negative carry, you expect to see that a very significant downward trend that comes from this negative carry. And because of that, it's much more likely to see profitable signals that are short rather than long in commodities, for example. Whereas if you look at some other asset classes, such as equities, there's an opposite behavior. So the carry tends to be positive, and you expect markets to go up, and that's why long bias in equity markets does make sense when you develop a time series momentum strategy. And that's exactly what we observed. So actually, if you look at our results, we found that when you condition signals of trend on the size of basis, which is a very, very simple signal, we can see very significant improvement in the Sharpe ratios of those strategies. So let me just clarify a little bit about what you're looking at. So TS-MOM is a trend strategy that gives equal notional allocation across all the strategies, across all the instruments. And TS-MOM-V is a strategy that was recommended by Toby Moskowitz in his 2012 paper that takes exposure in each market that's normalized to 40%. So in other words, it's equal risk-weighted allocation across all instruments. And what you can find here is that risk weighting signals tends to help. You can see that Sharpe ratios are higher. 0.56 is higher than 0.25. 0.73 is higher than 0.43. What we can also find is that conditional signals on the sign of basis improves performance.
Right.
And then the question becomes, if you're an investor, is that a good strategy? Because if you have a strategy that has a higher Sharpe ratio, but it tends to hurt you when the stock market struggles. For example, if you look at volatility selling, does great during good periods, but then it really crushes you during bad periods. And for example, if you look at Q1 of this year, there were actually a lot of volatility selling strategies that went out of business because they blew up because of the bad market environment. So we want to make sure that in this case, when we recommend a strategy that conditions the signal of trend on the sign of basis that would not have a similar behavior of good performance during good periods, but really bad performance during bad periods. So that's why we did additional analysis to evaluate performance by different macro environments.
Gotcha. So did you also review the paper, obviously from Koijin on carry, on global carry? So what I think many investors or listeners will be surprised about is, because typically carry is perceived as a pro-cyclical strategy, right? Because it's typically implemented on currencies, and in currencies it does manifest as relatively pro-cyclical. In other words, it hurts when it hurts to hurt. For people who typically own an equity heavy portfolio, a carry portfolio will typically do poorly or like a traditional currency carry portfolio will typically do poorly when equities are also doing poorly. And of course, when you diversify across all the major sectors, so into bonds and equities and commodities and currencies and volatility, notably, that you find that actually isn't the case, right? That the carry strategy doesn't really have any major pro-cyclical tendencies. So I guess based on that, you went into this expecting that pairing carry with trend across a diversified CTA universe would not introduce any meaningful pro-cyclicality. Is that what you observed?
Well, actually, I had a different suspicion. My suspicion was there would be some pro-cyclicality. So if you look at, and I'm well familiar with Koijin paper, it came out in the Journal of Financial Economics. And actually, I was very fortunate because Ralph Koijin was one of my advisors, my PG advisors. And he gave me some really valuable feedback on my dissertation. So what really happens is that, in general, when you look at carry trades, carry trade tends to be pro-cyclical, and there are reasons for that. Like, there's a lot of work done on FX carry. There's, for example, a paper by Nick Rusana from Wharton. It's called "Commodities and Carry: A Tale of Two Cities," and actually, what he does in that paper, he shows that he actually links FX and commodities, which is very interesting. He talks about countries that tend to export commodities and those that tend to import, and he shows how there's a link with the carry trade through transportation. But anyway, that's very fascinating to me. But anyway, so all that to say is that when I was looking at the results, my actually expectation was that if I condition the sign of trend, if I condition signal of trend on the sign of basis, I was actually worried that we're going to see more pro-cyclicality, and I did not find that. And I was looking at what was driving that. You can actually find that, for example, commodities tend to be very helpful for the behavior of the strategy. For example, when market crashes, commodities tend to struggle as well, and this strategy tends to short commodities. And also another example is fixed income. So fixed income tends to have positive carry, and it does tend to help to have loan bond exposure during crisis. So when you start looking at asset by asset, it actually does make sense that why this strategy performs better during time of crisis. But I was actually quite worried because when you take a simple carry implementation, it tends to behave poorly during time of crisis.
Right, but typically carry strategies focus on FX, and especially if you include emerging market FX, then that certainly enhances the pro-cyclicality, right? Okay.
But I just want to show the result because I think they're pretty striking. So if you look at expansion and recession, you can see that the unconditional time series momentum strategy performs slightly better during recessions. The Sharpe ratio goes up from 0.56 to 0.61, but performance of the conditional strategy is much stronger during recessions. You can see that the Sharpe ratio goes up from 0.68 to 1.05. And when you start looking at different stages of recessions and expansions, you can actually find that the strategy performs extremely well during early recession. And that's when the stock market struggles the most. So the strategy tends to add value during those periods when clients care the most about performance.
That's a really interesting observation. I mean, just thinking through the character of the carry strategy that we run, it performed extremely well, I think, counterintuitively in the very early part of the March downturn. And then as markets began to recover, it began to roll over and, do, relatively poorly. So it's sort of early recession versus late recession, given that the most recent recession played out over a matter of weeks. It's hardly a prototypical example, but it is interesting to see that it does map anecdotally to the average profile.
I think you have a really good implementation of the carry trade strategy based on what you described. So that's very impressive.